Tax filing for multi-state businesses in today's dynamic business landscape. Managing tax obligations across multiple states presents significant challenges for accounting professionals. As companies expand their operational footprint beyond traditional borders, the complexity of tax filing increases exponentially due to varying state laws, deadlines, and regulatory expectations. The intricacies of multi-state tax compliance demand precision, strategic planning, and adherence to ever-evolving legislative frameworks. Understanding these nuances is crucial not only for avoiding costly penalties but also for optimizing financial performance through effective tax strategy implementation. Jurisdictional complexities in tax compliance. Navigating the labyrinthine web of state-specific tax codes requires a deep understanding of apportionment formulas, nexus thresholds, and filing requirements. Each state defines its own criteria for determining whether a company owes tax liability based on physical or economic presence within its borders. Apportionment formulas, which allocate a company's revenue across states according to predefined metrics like property, payroll, or sales data, further complicate matters. These calculations often involve sophisticated mathematical models that necessitate meticulous record-keeping and analysis. Nexus determination. Establishing whether a business meets a state's threshold for taxable presence is foundational to tax filing. Physical factors include employees, warehouses, or offices. Economic indicators encompass remote sales, online interactions, or third-party fulfillment networks. Varying deadlines. State tax seasons diverge considerably, with many offering extensions during peak periods. For instance, California adheres to a strict April deadline, whereas New York provides flexibility until May, creating logistical hurdles for firms with broad geographical exposure. Compliance frameworks across states. Multi-state businesses must familiarize themselves with diverse compliance frameworks, ranging from stringent paper-based submissions to digital filing systems mandated by state departments of revenue. Failure to comply with these formats risks processing delays or rejection of returns. Digital transformation has streamlined tax submission processes for many jurisdictions, yet inconsistencies persist. While Texas employs an advanced e-filing platform integrated with corporate accounting software, others require standalone portals with rigid data entry protocols. Staying informed about each state's preferred method ensures timely and accurate filings. State-specific deadlines and extensions. Deadlines for state tax filings fluctuate widely, reflecting regional priorities and administrative capacities. Some states allow automatic extensions, while others enforce strict cutoff dates tied to federal tax timelines. Accounting teams must monitor these distinctions meticulously to avoid lapses in compliance. Extension requests typically hinge on meeting eligibility criteria, such as demonstrating ongoing business operations or lack of material discrepancies in prior filings. Proactive communication with state authorities remains essential when navigating extension processes to mitigate potential disputes over delayed submissions. Leveraging technology for streamlined compliance. Modern tax automation tools offer robust solutions for managing multi-state filings, consolidating disparate datasets into cohesive reports aligned with each state's requirements. Cloud-based platforms enable real-time monitoring of changing regulations, minimizing the risk of oversight. These technologies integrate seamlessly with enterprise resource planning (ERP) systems, automating reconciliation tasks and flagging anomalies before finalization. Additionally, AI-driven analytics enhance predictive capabilities regarding emerging trends in tax legislation, allowing proactive adjustments to compliance strategies. Challenges in record-keeping and documentation. Maintaining organized documentation becomes increasingly arduous as enterprises scale across multiple jurisdictions. Disparate retention policies and archival mandates necessitate a unified system capable of accommodating varied legal standards without sacrificing clarity or accessibility. Implementing standardized classification systems aids in categorizing receipts, invoices, and correspondence by location, date, and purpose. Regular audits verify completeness, ensuring alignment with statutory preservation requirements spanning several years post-fiscal year-end. Best practices for efficient document management. To optimize document management, businesses benefit from adopting digital repositories equipped with metadata tagging functionality. This enables rapid retrieval during audits or inspections while preserving chain of custody integrity for electronic files stored securely in encrypted environments. Training programs focused on staff education regarding archival procedures strengthen internal controls. Encouraging consistent labeling conventions reduces ambiguity around file origins and relevance, enhancing overall operational efficiency within the finance department. Payroll taxes. In a multi-state context, managing payroll taxes adds another dimension to multi-state tax compliance, particularly concerning wage withholdings, employer contributions, and unemployment insurance obligations dictated by individual states' labor statutes. Variations in minimum wage laws further compound complexity when calculating compensation structures. Cross-state employee mobility introduces additional variables, requiring employers to track employment history and residency status accurately. Mismatches here can lead to erroneous withholdings or misapplied credits, resulting in penalties upon discovery by regulatory bodies. Audit preparedness and risk mitigation strategies. Proactive preparation enhances resilience against unexpected audits initiated by state taxing authorities. Comprehensive documentation coupled with transparent disclosure mechanisms safeguards organizations against allegations of fraud or deliberate misrepresentation. Internal control measures should incorporate regular review cycles assessing conformity with updated guidelines. Engaging external advisors specializing in state tax law fortifies defenses against potential scrutiny, ensuring responses align precisely with evidentiary requirements. Conducting mock audits. Internally scheduling routine simulations allows identification of vulnerabilities ahead of actual examinations. These exercises test readiness across various facets, including data accuracy, procedural adherence, and personnel preparedness during interrogations. Post-exercise evaluations pinpoint areas needing improvement, guiding targeted enhancements in training modules or procedural workflows. Incorporating feedback loops fosters continuous refinement of audit defense strategies throughout organizational lifecycle stages. Integrating international considerations. Businesses engaged internationally encounter layered challenges stemming from dual governance by domestic and foreign entities. Navigating international treaties affecting cross-border trade demands nuanced interpretation of applicable agreements impacting duty assessments and value-added tax implications. Foreign tax credit claims represent pivotal components within global tax planning, balancing reductions against permissible offsets constrained by anti-abuse provisions embedded in bilateral accords. Precision in application prevents disallowance risks arising from improper allocation methodologies. Addressing transfer pricing challenges. Transfer pricing documentation assumes heightened significance amid multinational activities, aiming to justify intercompany transaction values under OECD guidelines. Detailed substantiation mitigates exposure to retaliatory actions by foreign regulators challenging perceived unfair advantages conferred through pricing arrangements. Periodic reassessments verify continued alignment with prevailing norms governing controlled transactions. Maintaining transparency across all tiers strengthens credibility vis-a-vis scrutiny posed by tax administrations pursuing aggressive enforcement campaigns globally. Optimizing tax strategy through strategic planning. Elevated awareness of fiscal incentives accessible regionally positions firms advantageously towards cost optimization objectives. Identifying jurisdictions offering favorable treatment toward innovation initiatives or infrastructure investments allows strategic relocation decisions influencing long-term profitability. Leveraging depreciation schedules tailored to local asset classifications enhances cash flow dynamics. Coordinating investment timing coinciding with transitional relief provisions maximizes savings accrued via accelerated expensing methodologies permitted selectively within defined windows. Pitfalls to avoid in multi-jurisdictional operations. Overlooking minor fluctuations in statute interpretations creates vulnerability points susceptible exploitation by auditors seeking technical infractions. Remaining abreast of amendments, even seemingly inconsequential, warrants vigilance commensurate with high-stakes compliance stakes involved. Relying solely on automated systems without human verification exposes organizations to error propagation cascading through entire filial hierarchies. Human oversight acts as critical safeguard, identifying exceptions beyond algorithmic recognition limits. Common errors leading to penalties. Frequent oversights include miscalculating apportionment bases due to inconsistent valuation methods applied inconsistently across regions. Underreporting intangible assets subjected to state-level capital gains treatments exacerbates susceptibility to retroactive corrections demanding substantial back payments plus interest accruals. Failure to adjust quarterly estimated payments accordingly after experiencing sudden revenue shifts results in unintentional underpayment scenarios triggering late fees unless preemptively adjusted via revised projection modeling grounded upon empirical forecasts. Emerging trends shaping future compliance landscapes. Advancements in artificial intelligence promise enhanced predictive analytics capabilities, foreseeing impending legislative modifications affecting tax regimes. Integrating machine learning algorithms assists anticipation rather than mere reactive adaptation, typical of current approaches prevalent within the sector. Blockchain implementations hold transformative potential, streamlining supply chain transparency, prerequisites demanded now by numerous states. Immutable ledger entries facilitate irrefutable evidence tracing goods movement, validating legitimacy assertions made during customs clearance phases. Conclusion: the multifaceted nature of multi-state tax filing underscores the imperative for specialized knowledge and adaptive agility within accounting disciplines. Continuous engagement with evolving legal landscapes ensures sustained compliance effectiveness amidst persistent regulatory flux. Adopting technologically empowered solutions alongside rigorous analytical rigor equips professionals confronting escalating demands inherent to contemporary business ecosystems. Prioritizing educational development maintains competitive edge, vital to thriving amid intensifying competition characterized by relentless innovation waves sweeping through modern economies.